All right, welcome to Your Time, Your Money, the show where your time is just as valuable as your money, and we know that. Welcome, Adam.
Glad to be here.
Well, I'm glad to have you here.
Yeah, this is fun.
The alternative's not good.
No, that's a fact.
So today's session, we thought we'd take it back down to the basics.
Yeah.
We've mixed in some basic investment stuff prior in some of our past episodes, but today I thought maybe it would be a good chance to spend a few minutes just on terminology.
Yeah, we were talking about this before, obviously, we started, and we get asked a lot of questions that you at times think, oh, wow, I'm surprised. Well, let me explain what that is, and that's obviously what we're covering today. But there's just a lot of those question marks out there that people misinterpret the definitions of things.
Yeah, and very often, seniors usually tell us like, hey, schools need to do a better job of educating individuals and kids about investing and basics and stuff. But then when you delve into it, a lot of times even seniors aren't familiar with what terms are and how they relate to the market. So today we're going to talk about some common used terminology, give you a brief description of it and why it's important to you. And then, hopefully you'll be a little bit more empowered when you're in conversation with a person about investing at, the family gathering or whatever it might be. So let's get started. It's your time.
Your money.
I'll let you do the honor
Oh,
here.
here we go. Watch out now.
So, I guess the first investment terminology that we should get into is the quote unquote the market, because we get that quite a bit, right?
Mm-hmm. Yep.
I mean, we get, the market's down or the market's up,
Yeah.
And our common response is, well, which market?
Right.
Right, and the market just refers to really the trading platform for different types of securities.
Yeah.
So you have the common terminology of the market would be the Dow or the S&P or the Russell 2000, the Nasdaq.
Yep.
And then the bond market has its own trading platform as well as other securities. So the one thing that investors need to understand is that just because one market is down doesn't mean another market's down.
Right.
And that's where later in our episode today, we're going to talk about diversification and allocation to the different markets. Is the market is such a broad term that it really just refers to the platform that securities or investments are traded on.
Right.
So there's no magical terminology of the market, right? It's a bunch of different markets.
Yeah, I was going to say, and a lot of times what can affect one market may not affect another. And a lot of times the interpretation of information that people, whether it's around the water cooler, they think that certain things affect a market. Who's president of the United States? We've talked about this before in the podcast. Or what decisions are being made, as the wind blows, whatever it is that causes a market in a person's mind to fluctuate, and the sort of the truths and realities behind what actually makes a market move.
Yeah, and some of the other terminology we hear is a bull market
Right.
or a bear market.
Yep.
Now, these aren't specific markets that they're referring to, but they're referring to the direction of a market.
Yeah.
Right? So if you have a bull market, the one thing I always tell clients is if it's a bull market, when a bull attacks, it usually attacks up with its horns. And it wants to go up, right? And that would be a bull. And in a fight, if a bear attacks, it's usually clawing down at you.
Yep.
And a bear wants to go down. So, that's referring to where people think the direction of the market's going to go. We complicate things. We can't say simple an up market or a down market.
Right.
We have to say either a bull market or a bear market. And that terminology is a lot of times misunderstood as far as like what direction the market's going.
Sure. And then the one thing that's not predictable in either a bear or bull is, of course, the direction or the duration, rather, of how long it's going to be a down market, quote unquote, or an up market.
Yeah, and they use those terms simultaneously within stocks. Are they detecting a bullish pattern or a bearish pattern in a stock or a security? Meaning, do they think it's on its way up and going up or going down? So if you hear that in passing, it's just referring to the direction of the market. Another thing too, that people hear is an asset class.
Right.
And they don't really understand what an asset class is sometimes.
Right.
And there's basically 4 different asset classes that we'll discuss today. First is equities. So that would be stock, and that would be most people relate to the market or investing on the stock side, right? That's an asset class. Next would be fixed income, right? Some examples of fixed income.
Bonds, preferred stock.
Bonds in general. Once again, going back to the market, It trades on its own market.
Right.
It's a different class of investment. If you think of a seesaw, a lot of times stocks and bonds act opposite of each other. Not so much last couple of years,
right.
But that's why you want to have different asset classes. And then you break that down even into more. There's derivatives, which has its own market. And this is option trading, a little bit more speculative trading, where you could risk a little bit of money. And if the market moves one way, you're leveraged. Right. And you can make 100 times more because you're leveraging or you have an option in that. You could also lose a lot of money.
Right. I was going to say
right?
you're dealing with a lot more risky decisions at that point.
Yep. So
greater risk, greater reward.
Yep. And derivatives can be all different types of investments. And then the final asset class is usually cash. Right, and that would be money markets, savings accounts, certificates of deposits would be under fixed income, but you would have cash as a liquid asset that you can access. So when people talk about what asset class are you in, they're referring to what type of investment are you in, and then how does that play. But those asset classes, when you put them all together, creates the next term, which is portfolio. Right, and you hear this a lot, like what's in your portfolio?
Right.
Well, maybe it's one thing. Right? It could be a rental property. It could be in a portfolio, right? Or it could be a portfolio full of all individual stocks, right? Which leads to, is it allocated properly or is it diversified properly? And both those things are different, right? Allocation refers to the asset classes. Do you have a little bit in each asset class? Do you have some fixed income? Do you have some equity? Do you have some stocks in there? Do you have some cash? Do you have some derivatives? That's asset allocation, whereas diversification is a little different, right? You can be diversified in stocks by having large, mid, and small, but you might not have the proper asset allocation.
Right.
And that's a confusing point for clients too, because a lot of clients will say, oh, I'm diversified.
Yeah, and that actually kind of rolls into when we talk about portfolios, a lot of times there's passively managed portfolios and actively managed. And passively managed is really think of it as a 401k. Someone picks their mutual funds, and then unless they go back in and are constantly trading those and changing those, sometimes, as often as daily, whatever, a person would want to do, they're passively managed. It's a set it and forget it kind of mentality often with 401ks. Or even other types of IRAs or non-retirement accounts. Whereas an actively managed portfolio, there is someone there making trades in the best interest of a client, and trying to protect as much as they can as the market is fluctuating, as well as taking advantage of opportunities as the market is fluctuating.
Yeah, maybe moving between asset classes if they needed to.
Yep.
Or even diversifying in the asset class
to
make sure that they're getting either a better return or reducing risk on the downside, right? And those are very important in a portfolio. But that whole asset allocation and diversification conversation is an investor needs to understand that they're two different things. Right, and that's important going forward. The other thing too that we wanted to bring up on this terminology that gets kind of intermingled a lot is interest versus dividend. Right, because a lot of times people say, well, what's it paying? Or, what's the interest on that account? Right. But they may be referring to an account that doesn't pay interest, it pays dividend. And the basic simple terminology of dividend versus interest is dividend is usually paid out per the number of shares you own. Yep. Interest is usually paid out off of the value of an investment. So like a savings account would pay interest. What are you getting? You're going to get
very little amount, but
a very little amount. Yes, maybe a stamp or whatever it might.
Right, 0.02%. Sure.
But interest will go up as your balance goes up, and will go down as your balance goes down. A dividend, though, being tied to a share, so to speak, if a value of a share goes down next month, your dividend could be the same.
Right.
Right, and if the value of your shares go down, sometimes the yield increases, so you get more money if things are reinvesting because you're buying more shares at a low. Yep. And the major difference between the two is if you're just drawing dividend off of an investment and that's coming in every month for you, right? No matter what your balance is doing, there's some consistency there.
Right.
Right? It's a paycheck, so to speak.
Yep.
Versus interest where you're taking whatever the borrower, so to speak, or the lender's willing to give you as a credit to your investment. Very interesting how people confuse the two.
Yeah, and to hopefully not confused more, but more for clarification on a dividend. A dividend, if it's a stock dividend, it may not be declared. It has to be declared by the board of directors if they're going to award a dividend on that time frame, whether it's a quarterly dividend or an annual or what have you. But it has to be declared in those cases.
Yeah, and we'll get into more episodes delving in deep into dividends and
Right.
and how they work and the reasoning behind them and why you want to
Yep.
have them, especially in your portfolio at retirement, because it's a paycheck, right?
Yeah.
Regardless,
Yep.
and interest isn't necessarily something you can live on when the low rates are low.
Yep.
Whereas dividend could be a healthy check for you
Yep.
to pay a bill, expense, or even live off of. And then this whole concept, which you brought up prior to the session today when we were just chatting, is investor return versus fund return.
Yeah.
Right.
Yeah.
So, the fund return or the return that you see on your statement that you see, in the mutual fund detailed section or electronic traded fund section, isn't necessarily the return that an investor gets.
Sure. Yeah, it's probably one of it is a question that I know I get asked a lot. We've talked about this, is that whole idea, well, what's your average return on your portfolios? And it's not a number that can be really given because it always depends on when a person gets invested into the market in that portfolio, at what time. So you're calculating all of these things all at once, and it's never going to be the same.
Yeah, so the fund return is just a mathematical
Right.
Performance of the mutual fund.
Right.
But if you invested in that mutual fund on Monday and I invested on Friday, we are both going to have different investment returns. Because during that week, if the portfolio went up 10% and I bought on Friday, my return is going to be less than your return.
Right.
And if it went down 10% by Friday, my return is going to be better than yours.
Right.
And both of those would be different than the mutual fund return maybe posted over the year.
Sure. Over the 12 months. Right.
Right. So
Yep.
so you could have a mutual fund that maybe posts a 5% or 6% return over 12 months, but because the investor got in 1 month later
Yep.
in the calendar year, right? They may have a 20% return because the first month the market dropped substantially,
Right.
and the investor got in at the right time.
Yep.
So I always tell clients, right, don't confuse investor return or your personal return with the posted return of the mutual fund,
Right.
because you probably didn't get that return,
Right.
right?
Yep. Yep. Yeah. It kind of goes back to what the markets do, and people think, well, I don't want to go into the market right now because I think it's going to go down further. You just can't time the market. I had people that clients of mine that had gotten into the investing part in the end of August, beginning of September. Well, that was when the market was at the lowest part in the last 12 months. And so their portfolios look fantastic when that was just the perfect timing.
Yeah.
Could I have planned that for everybody? I would have loved to,
and
but
investors
you can't.
fall victim to that water cooler talk all
Right.
the time, right? That somebody says, oh, I got 18% on my return last year.
Right.
I want to get into that same investment. Well, that's the rear view mirror approach.
Sure.
The investment already paid that out,
Yeah.
right? So that doesn't mean that's what you're going to get moving forward. But a lot of investors fall victim to that
Yep.
because it's the fear of missing out,
Sure.
right?
Yep.
FOMO.
FOMO.
Fear of missing out. And then as far as investment terminology goes, just maybe a simple definition of net worth,
Yep.
right? I mean, net worth in layman's terms, just pure simple definition that investors can understand. It's what you own minus what you owe. Right? You could have a multi-million-dollar house, $2 million home. You could have a mortgage of $2.1 million because the market went down a little bit,
Yeah.
and you have a negative net worth
Yeah.
because you can't sell that home for more than what you owe on it.
Yeah.
Right? So think of that as equity. And a lot of investors, especially early on in their 20s, 30s, and 40s, as they have their student loan debt, they just purchase a home or things along that lines, they may have a negative net worth
Mm-hmm.
their first 10 years or so. They might have a lot of savings put aside, but it pales in comparison to the amount of debt that they have.
Right.
And net worth, it's important to understand that
Sure.
because it doesn't necessarily feed you. Right? You could have a lot of net worth, but nothing to derive income in retirement.
Right.
Right? So net worth, and the other is liquid net worth.
Right.
Right? Refers to any assets that you can easily grab within a day or two.
Yep.
Right? Things that a mutual fund you could sell off and get proceeds the next day, plus or minus, depending on
Right.
what the market is doing, right? And liquid net worth is important to understand because liquid net worth usually relates to how do you derive income. in retirement.
Right. And even prior to retirement, a lot of conversations go to where people are putting money into their 401ks or their IRAs, not understanding that they can't touch those dollars until they're 59 and a half without a penalty and taxes, of course. So, finding solutions that offer investments with liquidity options as well during that savings time frame. Sometimes that's important to someone, depending on what their needs are going to be.
Yeah, and I think we did a good job of touching on the investment terminology and basic things that we wanted. Anything else that you think we should bring up?
No, I think that's pretty much it for now.
Great.
Again, a lot of what we touched on today could be full episodes, no doubt. And some of the stuff we've touched on today have been full episodes. So.
Yeah, and we'll keep pushing out some good content individually on these terms and delving in depth in future episodes. But I thought from a terminology standpoint, it's good that investors out there and listeners out there understand what these terms are, because they're hearing them all the time, right? So as always, it's your time, your money, and you can find us at 43 British American Boulevard, Latham, New York, 800-222-3202, Latham, New York, 12110. Address and phone number, two separate things. Or as always, yourtimeyourmoney.net. And like and subscribe allows us to get our good messages and content out there as much as possible. And as always, it's your time,
your money.